In October 2014, an anonymous trader dumped 30,000 Bitcoin on the open market, which at the time was worth about 9 million US dollars. The Bitcoin community rallied on social media, urging people to buy up the coins. And over the course of several hours, the entire wall was eaten through, and the price of Bitcoin quickly rebounded. This became known as the slaying of the bear whale.
This podcast is for information and entertainment purposes only. Nothing on this podcast should be construed as financial advice. All views expressed on this podcast are solely the opinions of the host and/or any guests that we might have from time to time. Nothing on this podcast should be construed as a specific inducement to make a particular investment or to follow a particular investing strategy.
Guten Tag, Buenos Dias, Morian, and welcome to episode 227 of the Bitcoin Bulletin Podcast. Today marks the first DCA Wednesday of a brand new stacking epoch, having completed 4 years of weekly dollar cost averaging with last Wednesday's DCA episode. A lot has changed in the last 4 years, and as I have mentioned ad nauseum by this point, it certainly feels like we have finally reached the precipice of the suddenly part, with so much changing in the last few months. If you've been listening to this podcast, you've heard me say over and over again, so I'm going to let someone else say it. VJ Boyapati tweeted just 2 days ago on Twitter or X, "We went from the entire state apparatus being adversarial to Bitcoin to the 6th largest treasury company being owned by the president's family, not priced in." And speaking of this 180-degree regulatory change, Gary Gensler's replacement, the new SEC chairman Paul Atkins, tweeted just yesterday, "I'm pleased to share that the SEC approved in-kind creations and redemptions for crypto ETPs. The approvals continue to build a rational regulatory framework for crypto, leading to a deeper and more dynamic market which will benefit all American investors." What he's referring to, of course, is the SEC's approval of in-kind exchanges for the Bitcoin ETFs, something that is potentially huge because right now, if you are investing in the ETFs, you do so with US dollars. And then when you sell those ETFs, you get US dollars in exchange. And of course, that leads to a capital gains situation currently, etc. And if you purchase into the ETF by depositing Bitcoin, when you cash out of that ETF or move into a different ETF or whatever you would do, not recommending that you invest in the ETFs, but when you do, if you do so on an in-kind basis, if you put 1 Bitcoin into the ETF and you withdraw 1 Bitcoin, of course you haven't had a capital gain. And there are other reasons why that's exciting as well, but it's just another one of those things that's 180 degrees different from where we were with the previous Securities and Exchange Commission chairman, for example. All right, I am getting a little bit ahead of myself here, so before we get into any more of the news, let's take a couple of minutes to take our customary look at Bitcoin's vital statistics. At the time of this recording, we are sitting at a block height of block 907,874, and Bitcoin is ringing in at a whopping 117,840 US dollars. And I know a lot of people are disappointed that we're, 4% below the all-time high that we set just a couple of weeks ago. But that, I want to remind you, is only about $300 below where we were last DCA Wednesday. And if the price holds right where it's at, it's going to be the second or third most expensive that we have ever purchased Bitcoin on a DCA Wednesday episode. So zooming out to just a weekly basis, we're pretty much at an all-time record high. We're within $300 or $400 of what the all-time record high for our DCA Wednesday purchases would have been. Bitcoin's current US dollar value means that every US dollar you convert into Bitcoin will purchase you 849 sats. That's about 3 Satoshis. Well, it's exactly 3 Satoshis per dollar more than last DCA Wednesday because the price is, like I said, about $300 cheaper at the moment. And that's good because the whole idea is to stack as many sats as you can. So if we were at a brand new all-time high, you'd be getting even fewer Satoshis. And since the goal is to stack more sats, this makes me happy. Bitcoin's current price means that it has a market capitalization of 2.34 trillion US dollars. Again, just under the 2.36 trillion all-time high, at least as far as what we've observed on Wednesdays during the DCA Wednesday series of this podcast. The third highest market cap that we've seen. So again, just zooming out, even on a weekly basis, makes a tremendous difference in perspective for everybody that's out there thinking that the sky is falling. Of course, we had the price of Bitcoin retrace quite a bit, a couple of times in the last couple of days. We'll get into that a little bit more in the news segment, but ultimately, as Adam Meister says at TechBalt on Twitter, you are just one day closer to the next all-time high as this bull run marches on. For those of you who value wealth in shiny yellow rocks, it's gotten a little bit more expensive for you to purchase Bitcoin. Currently, it will cost you 35.5 ounces of gold to purchase just one Bitcoin, almost a full ounce more than last DCA Wednesday, even though the US dollar price of Bitcoin is down just a little bit, as everything, including US dollars and gold, trend to zero in Bitcoin terms. For those of you who value your wealth in pizza, one Bitcoin would currently purchase you 6,590 large pepperoni pizzas from Papa John's. That is still more than 18 years of pizza if you purchase one large pepperoni pizza every day with your Bitcoin. Of course, 18 years from now is multiple halving cycles from now, and presumably multiple new all-time highs from now. So, as I mentioned on numerous podcasts, if you had one whole Bitcoin and it was your goal to spend that Bitcoin by purchasing just one pizza a day, an homage to Laszlo on that first Bitcoin pizza day, that you could never do so because the value of that Bitcoin will increase faster than you can spend it. Certainly at 18 years, being more than 4 halvings away, I don't think it would even take 2 more halvings before that would be more than a lifetime's worth of pizza and rapidly become an impossibility. So that's pretty cool that in theory, if you had one Bitcoin and you had absolutely nothing else, you could try and survive on one pizza a day, and you'd have food potentially for infinity. All right, that metric that you know has been my favorite metric for most of this, or for all of this, the history of the Bitcoin Bulletin Podcast, more than 4 years now, is Bitcoin's 24-hour average transaction rate. And it is just zooming along, currently averaging more than 5 transactions per second on chain, 5.07 on chain transactions per second, that is. And I'm not a TA guy. I don't think you can draw lines on charts or look at any particular number and determine where the price of Bitcoin is going to go. But in the 4 years we were doing this podcast and just looking casually and anecdotally at this metric, anytime we had really healthy on-chain activity that usually was reflective of also an increase in Bitcoin's price, something that we certainly see this week as well. Again, correlation does not equal causation, but it's fun to look at. And speaking of on-chain activity, the Bitcoin mempool, it remains absolutely chock full of pending transactions. Depending on whose mempool you're looking at, Clark Moody's dashboard mempool is showing 7,539 pending transactions, up from 4,334 last Wednesday. And of course, mempool.space has a dramatically larger mempool once again, and that is because they're including sub-Satoshi transactions in their mempool, something that I believe most mempools screen out by default. Any transaction that includes a miner fee of less than 1 sat per VByte, most mempools will filter those out, but mempool.space's mempool is including those. And as a result, there are more than 60,000 transactions pending in mempool.space's mempool. 60,688 to be precise. But looking at that a little more granularly, bit of a tongue twister there. A large percentage of those additional transactions, well, the vast majority of those additional transactions are sub-Satoshi miner fee transactions, which means that they're not going to affect the transaction that you might send getting mined in the next block or two if you include more than 1 sat per VByte, or at least 1 sat per VByte in your transaction. Speaking of transaction fees, mempool.space is recommending 5 sats per VByte for a high priority transaction. That works out to 82 cents in US dollar terms. However, it's been 42 minutes since the last block was mined, so take that with a bit of a grain of salt, because the very last block actually included at least 1/2 a Satoshi per VByte miner fee. And just because transactions have been stacking up for the last 42 minutes, the fee estimators are saying it's going to be a little more expensive if you want to guarantee that your Bitcoin is included in the next block. And that might very well be the case. But after we get 1 or 2 more blocks in, most likely that fee will come back down a bit. Along those lines, mempool.space is saying that if you have a medium priority transaction, it only needs a fee of 4 sats per VByte, and a low or no priority transaction will still be mined at just 1 sat per VByte. Clark Moody's dashboard is saying a fee of 3 sats per VByte will be sufficient for a high priority transaction, and that any other transaction can get away with a 1 sat per VByte miner fee, something that obviously jives with the fact that I'm looking at the last several blocks, and 2 blocks ago the lowest fee was 1 sat per VByte, but still the last several blocks had 1 sat per VByte transactions mined readily. So it seems that once the blocks start coming back in again, that will be the case shortly, if not by the time you're listening to this podcast. Since the last Bitcoin Bulletin podcast, the difficulty that it takes to mine a block was increased by 1.1%. That is approximately, well, that's a little bit higher than what we were looking at last DCA Wednesday, when the forecasts were anywhere between a 0.2 and a 0.91% difficulty increase. But that is because, just like the price of Bitcoin continues to go up into the right, in general, when you zoom out, the hash power, the computer power securing the Bitcoin network, also goes up into the right, which means there's more compute competing to mine the next block, which means it's going to have to get more and more difficult to do so in order to keep blocks coming in at an average of once every 10 minutes. Bitcoin adjusts that difficulty every 2016 blocks, which theoretically works out to every 2 weeks, with the goal of maintaining that 10-minute block time. And currently we are 1,342 blocks away from the next mining difficulty adjustment, a little more than 9 days from now, sometime around August 9th. And it's currently looking like it's going to be another decrease, perhaps a substantial decrease. Depending where you get your data, I'm looking at anywhere from a minus 2.09% decrease in difficulty to a minus 5.3% difficulty adjustment. And I haven't seen any news or any chatter online or social media referencing why that is the case. Sometimes that just happens, but I can tell you from personal experience, it is hot. It was 93 degrees Fahrenheit here in Central Florida today, and I was looking at the weather out west because I need to go out to Texas and New Mexico in the not too distant future, and it was over 100 degrees Fahrenheit out there. And any time it gets really hot, the demand for electricity goes up, particularly in Texas. And of course, they have the demand response agreements with the grid there, and they have large mining facilities like the Riot facility in Rockdale, Texas, for example, that agree to shut their miners off when there's tremendous electricity load. They get paid to do that, of course. But when that happens, whether it's a heat wave or whether it was the ice storms in Texas a few years ago when there was an equally high demand for electricity, but for the opposite reasons, and there was also a lack of electricity production because the windmills were frozen and not moving. So it was a double whammy. The point being, these miners, when they turn off on purpose, sometimes that results in a decrease in the network hash rate and the corresponding decrease in difficulty to mine the next block, something that usually within the next difficulty adjustment period has been eaten back up and more so. For example, what was it? 3 or 4? It was 3 difficulty adjustments previously. We had, what was it? An 8. It was a 7.5% difficulty decrease, but then that was followed by an 8% increase and then another 1.1% increase. So continuing that march up and to the right. Again, it's just one of those things if you zoom out. But why this is really important is if you're mining at home, or if you're, solo mining with a bit axe, your chances of mining a block got a little bit better, and maybe it'll be a little bit more profitable for you after the next difficulty adjustment sometime around August 9th. For you and me and the average pleb out there who are just transacting in Bitcoin, especially if you're using the Lightning Network, it will make no noticeable difference to your day-to-day activities whatsoever. But the reason we're looking at that difficulty increase is because blocks are currently averaging 10 minutes and 34 seconds, and obviously that is longer than 10 minutes, and hence the difficulty decrease as long as that continues to be the case. The 90-day estimate of hash rate securing the network, however, is up from last DCA Wednesday. It's estimated there are 889.2 exahash securing the network. up from 885.3 exahash last DCA Wednesday. I've heard on social media and other podcasters say that we beat the 1 zeta hash mark again. And that may very well be the case, but nobody actually knows what the exact hash rate securing the network is. These are all just estimates. And I usually reference the 90-day hash rate estimate because these things ebb and flow. Blocks come in, well, they come in on random chance, basically. So sometimes blocks come in back to back, 1 or 2 blocks within a minute, and sometimes they take more than an hour, like it's trending right now. And that's why you look at a larger picture to determine what the hash rate is. And by averaging it out over 90 days, I think you get a much more reasonable estimate, because that's what it is an estimate. There's no actual factual gauge for exactly how much hash rate is on the network. Before we continue to the news, I want to take a minute to thank those of you listening on your favorite Podcasting 2.0 apps, such as Fountain. Podcasting 2.0 allows you to contribute value back to this podcast by either streaming sats on a minute-by-minute basis as you listen, or by sending a boost, which is a shout-out via a Lightning transaction. But because it is a Lightning transaction, you are sending value back to the podcast in the form of Satoshis. Of course, when you do send a boost, we read it on the next episode. And speaking of you, the listeners, our geographic distribution listeners remains ossified. Our top 10 countries of listenership remain as follows. Number 1, where more than half of you are listening, remains the United States of America. So hello and thank you to my fellow Americans out there in the United States. Regardless of which state you might find yourself in, chances are it's a heat wave where you are, as we're getting into the hottest part of summer in general. And there's a little bit of a high pressure heat dome built up over the center part of the country as well. So once again, thank you to my fellow Americans, regardless of where you may find yourself today. Number 2 remains Singapore. So hello and thank you, apa kabar, to those of you listening in Singapore. Number 3 remains Germany. So Dankeschön, mein Freunds in Deutschland. Number 4 remains Argentina. So hola, muchas gracias amigos in Argentina. Number 5 remains Luxembourg. So Dankeschön, mein Freunds in Luxembourg, or Morien to those of you speaking Luxembourgish. Number 6 remains Canada, where it's probably also warmer than normal. I didn't actually look at the weather report up there, but if the heat dome is over the Great Plains of the central United States, it makes sense. It's probably a little warmer in Canada too, although certainly not as hot as it is in the southwestern United States or here in Florida. So once again, thank you to those of you listening in the hopefully cooler Canada. Number 7 remains our cousins across the pond in the United Kingdom. So hello and thank you to those of you listening in the UK. Number 8 remains Spain. So hola, muchas gracias amigos in Spain. Number 9 remains our cousins down under in Australia, where it is currently winter because they're on the bottom side of the world. And number 10 remains Mexico. So hola, muchas gracias amigos in Mexico. All right, on to the news. Of course, everybody was watching the U.S. Federal Reserve today to see what they would do about interest rates. And of course, they announced that they would keep interest rates unchanged at the conclusion of its July FOMC meeting this afternoon. That was largely expected, despite the fact that there have been numerous people, particularly President Trump in general, demanding that the Fed cut rates and that it do so sooner rather than later. But they didn't. And I guess that was a little more contentious than previous rate announcements because 2 of the Fed governors actually voted to change rates, apparently. It was also widely anticipated that today we would find out additional details about the U.S. Strategic Bitcoin Reserve with the release of the, quote, Strengthening American Leadership in Digital Financial Technology report commissioned by the White House. Yesterday, CNBC's Squawk Box reported that would be the case. However, no additional details on the SBR were included in the report released today. Instead, it was essentially a rehash of the legislation that's already been put forward in Congress, some of which has already passed. Bills such as the Digital Asset Market Clarity Act and the Genius Act were detailed in the report. So basically more of the same, a little disappointing, but again, completely refreshing that at least it's a positive look at Bitcoin in lieu of the anti-crypto army that the previous administration was building. Bitcoin mining and treasury company Mara Holdings found a nugget in the report that they touted on Twitter this afternoon, posting on X. The White House published a comprehensive report on digital assets, stating that Bitcoin miners are, quote, well-suited partners for utility load response programs and grid stability. We agree, and we're ready to advance America's energy systems. Something that we spoke about when we were talking about difficulty and hash rate, with the miners agreeing to partner with the grids to use electricity when it's abundant and curtail their use of electricity when there are times of high demand. After the release of the report, the price of Bitcoin dipped briefly, perhaps a sell the news kind of event, or maybe in disappointment over a big announcement related to the lack of a big announcement related to the United States Strategic Bitcoin Reserve. Bitcoin Magazine blamed the dip on the Fed, stating, Bitcoin Magazine blamed the dip on the White House report, saying Bitcoin dips below 116,000 after White House releases digital asset report. CoinDesk, however, blamed it on the Fed Chairman Powell's briefing, with their headline, "Crypto bulls get hit with $200 million in liquidations as Powell rattles the market with Fed warning." That being said, at the time of this recording, just as with the 80,000 Bitcoin dump last week and the bear whale that we referenced in the intro to this program, the market apparently easily absorbed the $200 million liquidation wave, because Bitcoin is right around 118,000 US dollars at this moment, significantly up from the upper $115,000 range that it dipped to earlier this afternoon. Adam Back chimed in on Bitcoin's price, tweeting yesterday, 118K is the new 58K gang, for the moment anyway. Something I've referenced on this podcast as well. I certainly do get that feeling. It is funny, Bitcoin changes you, and one of the ways it changes you is it elevates your expectations based on price, amongst other things. Other than changing your worldview, your view on, freedom and technology, it also, every time it sets a new all-time high, the previous new all-time high, when we broke 100,000 for the first time at the beginning of this year, we're now almost 120,000 again, 118,000 at the moment, 18,000 US dollars higher than that previous all-time high, which would have been a big deal back then. But since we hit 123,000, something about the way that the human mind works, all of a sudden 118,000 is disappointing. And while it seems that Bitcoin has been loitering at the 118,000 mark for quite a while, really it's only been there for a couple of weeks when you zoom out and look at the price. And I firmly believe, and I've spoken about this, and I'll talk about it a little bit more before we wrap up the podcast in a bit, but I still get 2017 vibes. This bull run still feels a lot like 2017. And in 2017, we spent 6 months of that year just hovering right around the 1,000 US dollar mark. And then, of course, Bitcoin didn't really go absolutely bananas until September, October, November, and December that year. So the last 3 or 4 month period where Bitcoin vaulted to the new all-time high around 20,000 US dollars, which was 20x from where it started the year. So if this were similar, and I have no way of knowing that that's the case, it's just the feeling that I've been getting, is that Bitcoin started out around 100,000 US dollars, and it kind of serpentined around that 100,000 US dollar line for 6 months, just like it did the $1,000 line in 2017. And now we've started gradually going up, just like we did in the summer of 2017. Of course, in, I believe it was August or it was September of 2017, that was actually a down month. Bitcoin retraced, closed the month lower than it did higher than it started. But then, of course, October, November, and December, the growth was just explosive, going from around 4,000 US dollars to 20,000 US dollars. An insane return, 5x in just a couple of months. And if Bitcoin were to do that kind of thing, each halving, because of the increase in hash rate, has happened a little earlier, every halving cycle, about a month earlier. So in 2017, we had the all-time high in December, but that was about the same number of blocks from the halving that it was the next halving cycle, where we had the all-time high in November. And then if the same thing applies, the same number of blocks from the halving would now occur in maybe the end of October. I think I said it was going to be about October 19th, going by block height time now, and not by human time. Not by number of months. Well, even by number of months from the halving, because the halving occurred earlier. So you have to adjust what 2017 looks by the summer 2017 looks like by a month or two, by about 2 months actually. So if we were going to have another down month during the bull run like we did in 2017, that would be happening right about now. And then when Bitcoin started exploding again would maybe start happening in August or the end of August. And then we would see September and October just being absolutely nuts. And hey, if Bitcoin 20x's from the beginning of the year like it did in 2017, that'd be talking $2 million Bitcoin. Something that would just be mind-boggling. And I'm not predicting $2 million Bitcoin. If you had asked me what I thought we were going to do this cycle before the cycle hat started, and I think I even talked about this because I made many predictions about what this cycle would look like before the cycle happened, not necessarily price predictions, but how it would go in general, I would have thought maybe we hit 250 or 300,000 this cycle, but nobody knows. Nobody has a crystal ball. If we continue to mimic 2017, maybe we hit 1 million or 2 million this cycle. It's certainly possible. There are plenty of people who are predicting that. Maybe we only hit 150 or 200,000. I guess we won't know till it's all said and done, but as I say, hindsight is 2020. But I do want to remind you that, remember, there were plenty of people out there on social media and I think it was even on the Cafe Bitcoin spaces saying that this cycle was not even going to have a new all-time high because, remember, there were people saying that Bitcoin, all of their gains were basically in a low or no interest rate environment with excessive quantitative easing, with the Fed pumping and the U.S. government printing, and that wasn't happening at the moment with interest rates being higher, with the Fed not cutting, and therefore we weren't even going to have a new all-time high. Clearly, they've already been proven wrong. Speaking of bear whales, that 80,000 Bitcoin sale that we were speculating about last DCA Wednesday, I guess on Friday, and this is kind of old news now, but it was confirmed by Galaxy in a press release saying Galaxy executes one of the largest notional Bitcoin transactions ever, bragging basically that they sold 80,000 Bitcoin on the market, $9 billion worth of Bitcoin, something that did dump the market down, dump the price of Bitcoin. But then, of course, it completely recovered almost about to the $120,000 range again before it trended down this afternoon, and then, of course, bounced back to where we are right now. Jack Mallers commented on this on Saturday when he tweeted, "The market absorbing 80,000 Bitcoin, 10 billion, in days with barely a blip is a big deal. Bitcoin isn't fragile. Armchair analysts warning about treasury sell-offs crashing Bitcoin might want to think again. Going to take orders of magnitude more than 80K Bitcoin to stop what's coming." That's something I agree. And speaking of those treasury companies that he was alluding to, possibly, the FUD of those companies possibly selling, dumping their Bitcoin and crashing the market, on Sunday, it was announced that Metaplanet had purchased an additional 780 Bitcoin for $93 million. They now hold 17,132 Bitcoin, valued at more than $2 billion US dollars. And then on Monday, Bitcoin Magazine tweeted, "Just in, French company Capital B, the blockchain group, purchases 58 Bitcoin for 5.9 million euros. And not to be outdone, Michael Saylor's Strategy tweeted yesterday that they had acquired more Bitcoin, posting, "Strategy has acquired 21,021 Bitcoin for 2.46 billion US dollars at $117,256 per Bitcoin and has achieved BTC yield of 25% year-to-date 2025. As of 7/29/2025, we hodl 628,791 Bitcoin, acquired for $46.08 billion at $73,277 per Bitcoin." So corporate and institutional FOMO continues, perhaps buying up some of those 80,000 Bitcoin that Galaxy Digital dumped. But again, I want to remind you that it takes a lot to stop this train. And we're not just talking about Lynn Alden's train, which is talking about money printer go burr. I'm talking about human psychology and momentum, and the fact that the market is still undergoing price discovery for the supply shock of the halving. That's something that traditionally takes 18 months or more from the halving to occur. And I still believe that we're not going to see the peak of this bull market until later this fall or early winter. But again, nobody has a crystal ball. So with that in mind, I have hypothesized that that we're going to say that we're going to that this bull run hasn't even really begun yet. That we are functionally in the equivalent of the summer of 2017, where Bitcoin was floundering around in the low $1,000 to $2,000 range before it exploded to 20,000, and the rest was history. Again, nobody has that crystal ball, and it's impossible to predict what Bitcoin will do, especially on a day-to-day basis. But if this time does not turn out to be different, everybody always says this cycle is going to be different, whether they say things like there wasn't going to be a new all-time high because of the high interest rates, or whether we're going to achieve the mythical super cycle where we achieve escape velocity and there's no more bear markets. Whatever. If history continues to rhyme, that's just what I expect to see, not any official forecast. All right. On to what makes today and every Wednesday special, and that is that today is DCA Wednesday. What is DCA, you might ask? Well, DCA is short for dollar cost averaging, and dollar cost averaging is an investment strategy where you invest your money in equal portions at regular intervals, regardless of price. For example, we set our equal portion at just $20, something I wanted to keep simple enough that anybody listening to this podcast, almost anybody, should be able to come up with on a weekly basis. Again, that's a you do you thing. If you're Michael Saylor, you're not going to be DCAing just $20 a week. So, you set your equal portion. The point being that you set it and forget it. And of course, we chose weekly as our regular interval, once a week on Wednesdays. I chose that for two reasons. First, almost everybody I know that DCAs into any investment, whether it's into their 401k or a particular stock or just their savings account, they usually do so out of their paycheck on payday, whenever they get paid. And most people I know get paid once a week. Some people get paid every other week, so maybe they DCA bi-weekly instead of weekly. But the other reason was it just makes, DCAing weekly makes a nice time frame for a weekly podcast. So we started our DCA journey more than 4 years ago now. Our first DCA Wednesday was all the way back on July 28th, 2021, so just a little over 4 years ago. And in that time, there were 209 Wednesdays, and we stacked 209 times, converting a total of $4,180 at just $20 a week into a stack of more than 0.1 Bitcoin, 10,854,908 Satoshis to be exact. And we did that at an average purchase price by dollar cost averaging of just $38,507.98, which is not too shabby at all, considering that the current US dollar value of Bitcoin is right about 118,000 US dollars. So a heck of a return already, and we're just getting started. So to grow that stack today, once again, I'm going to use Strike. I've already got money on Strike, but that's one of the neat things about Strike is that they will let you transfer money in instantly and purchase Bitcoin with that money instantly, depending on how new your account is. They might not let you transfer that Bitcoin out of your Strike account until that money has officially settled from your bank account, because it is fiat, and the fiat system is not instant like Bitcoin. It is slow and archaic, and so because that money can get clawed back or fail to actually transfer, they usually wait until it's settled, which is like a week, 7 to 10 business days or something like that. But the point being, they're going to let me purchase Bitcoin immediately, even if I didn't have money on Strike, but I do, so that's moot. This is also a you do you thing. Strike is not a sponsor of this show, and I'm not necessarily endorsing Strike. We were using Cash App. That was what I thought was the easiest way to stack until they dramatically increased their fees a couple of months ago. So then we switched to Strike, but Strike and Cash App might not even be available where you're at. So pick a well-known exchange, something that isn't a fly-by-night company you've never heard of, something that is a mainstream exchange that's available wherever you're listening. The important thing is, once you have enough Bitcoin that it's not just going to be a dust transaction, get that Bitcoin off of that exchange and into your self-custody, and then it really doesn't matter. I mean, you could have been investing with FTX, and as long as you were transferring that Bitcoin out of FTX when they went bankrupt, it wouldn't have affected you. And so as long as you follow those general rules, you should be fine. But that is a do your own research kind of thing. So as I mentioned, I have $20 in Strike, so it's just a matter of tapping buy Bitcoin, entering $20, tapping OK, And boom, just like that, we purchased another 16,775 Satoshis, bringing our stack now to 10,871,683 sats. It does increase our average cost basis by about another $124, so our average purchase price is now $38,632.47. That is still not too shabby, considering at the moment Bitcoin is ringing in just a little over 118,000 US dollars. In fact, we purchased at $118,092.40 before you include the fees and a little bit of spread that Strike charges. With fees, etc., we paid about $119,225 per Bitcoin, but every exchange has to make money, and all of them charge some combination of fees and or spread above and beyond, so you don't invest the full 20 into Satoshis. We had about 20 cents in fees and a little bit of a spread. Again, that's one of those do your own research things. But what's really cool, besides the fact that we have such a low average cost basis, only $38,632.47, when the price of Bitcoin is worth well over 100,000 US dollars, when Bitcoin hits $200,000, that current stack of sats will have a US dollar value of more than $21,000. $21,743.36. Not too shabby, considering we've converted now just 4,200 US dollars into Bitcoin, and we did so at just $20 a week. There are plenty of people out there who predict that Bitcoin will hit 1 million US dollars by the end of this bull run. I have no idea whether it will do that or not, but I do believe that Bitcoin will eventually hit $1 million, whether it's this year or whether it happens after the 2028 halving or whenever. But when it does, without adding a single extra Satoshi to the stack, it would have a US dollar value of more than 100,000 US dollars. $108,716.83 to be precise. Bitcoin OG Adam Back, who we quoted earlier in this podcast, he said that he believes by 2032, Bitcoin will be worth more than 10 million US dollars. Again, nobody has a crystal ball, not even Adam Back. Although if anybody gets any credibility in Bitcoin, I think someone like Adam, who's mentioned in the white paper by name, deserves a little bit more credibility in such things. And Adam Back believes that by 2032, Bitcoin will be worth 10 million US dollars. And when that happens, our current stack would have a US dollar value of $1,087,168.30. An insane return for just 4,200 US dollars. And of course, Fidelity's director of global macro, Jurrian Timmer, said back in 2022 that Fidelity believes that by the year 2038, one Bitcoin will be worth more than 1 billion US dollars. Staggering to think about, but 118,000 was pretty staggering to think about at the beginning of 2017, even more so earlier than that. So it's definitely not out of the realm of possibility. And if and when that happens, our current stack could be worth more than 100 million US dollars, 108,716,830 US dollars to be precise. Just a stupefying, impossible to comprehend return for 4,200 US dollars. And of course, remember, this isn't about the gains. This isn't a get-rich-quick scheme. A lot of us are into Bitcoin for different reasons. Some of us are here for the technology. Most of us are here for the FU money aspect, the freedom aspect, or like Michael Saylor, to prevent the government from deflating your life savings, the hours of your life that you've worked and traded to paper dollars that they're stealing through inflation, to put a halt to that. So the fact that in addition to preserving your wealth, protecting yourself from printing, from governments devaluing your currency, stealing those hours of your life, the fact that we could end up with a huge monetary return that would put us would make us the new financial elite in the world is just it's mind-boggling to think of. It's staggeringly almost incomprehensible, even though I firmly believe that it will happen one day. All right, as usual, before I wrap up, I want to once again thank each and every one of you for an amazing 4 years of Bitcoin Bulletin podcasts. It is you who makes Bitcoin special, and it is you who makes it so fulfilling for me to do this podcast. As a reminder, I keep my DMs open on Twitter or X and I enjoy hearing from you, and I do respond to those DMs if they're from a pleb and not just spam. If you're not already following us on Twitter, you can reach me on X at BTC Bulletin Pod. Of course, following us also helps feed that algorithm monster, which helps promote the podcast. Of course, if you don't use Twitter, you can also send me a good old-fashioned email. My email is open right now, and I also respond to the emails. The email for this podcast is bitcoinbulletin@protonmail.com. That's bitcoinbulletin@protonmail.com. Once again, thank you from the bottom of my heart for an amazing 4 years, and hopefully many more years in the future, exploring and stacking Bitcoin together. And of course, along those lines, don't forget to join us next Wednesday and every Wednesday as we continue that Bitcoin journey. But until that time, keep on stacking those sats, you sexy sat stackers.